Talk about it. Let's go over it. This is going to be how to buy at support without getting trapped. Before we jump into the chart work, it's important for us to understand the fundamentals. So let's get straight into it here. So, how to buy support without getting trapped. Every trader has done it. Say price pulls back to a level that it looks like is support, right? Say you buy and then price keeps falling anyway. Today, we're going to break down exactly why that happens and let's build a repeatable process so it stops happening to you. And before we start, ask yourself the question and really sit with it. When you buy at support, are you buying because price reacted there or because price simply arrived there? That simple distinction separates a professional rule-based entry from a guess dressed up as analysis. So what support actually means is it's an area where buyers decide to sell. Okay, the psychology of a trap. A trap is going to be a fake out area, an area that looks like price might want to react there, but doesn't quite have enough orders. Okay, let's go and let's keep going over everything. So what support actually means? Support is a price zone. Okay, it's a zone. It's never really just a relatively single line. Even if you might see me do lines, a lot of times it's going to be within a zone. And it's going to be where buying pressure has historically overwhelmed selling pressure, which made it enough to pause or reverse a decline. It forms because real orders are resting nearby, and retail limit buys, institutional accumulation, algorithmic bids, limit orders, and stop loss clusters from short sellers all stack up around the same general area. And new traders draw a thin line on the chart and treat it like a laser guided floor. Professionals draw a shaded box. That's what you guys see me draw on the box, because price always doesn't respect the exact tick. It can sometimes, but price will respect the level within a zone. It respects the neighborhood. Understanding this will stop a huge percentage of you just closing your trades out too early. Make sure you guys give your rooms for yourself for stop loss. You know what I'm saying? Okay, make sure you guys look at multiple different wicks within a support zone before you just mark out the line. So make sure you guys mark out the zone, not a line. Support is a range where reactions have repeatedly occurred, not just one price. So when you guys see market coming down, bouncing in an upwards direction, even let's say if market decides to invalidate support, come back up and bounce from it again, still going to be support. And support, once again, is built from history. You're taking the areas of support to your left and waiting for it to react again to your right in current price. And round numbers matter. Psychological levels like $50 or $100 attract clustered orders naturally. And order clusters, stops, limit buys, and institutional algorithms bunch up near the same prices. Okay, so for example, say a stock bounces near 48.20 and then 48.50 and then 47.90. Okay, it's respecting the same average zone. Okay, there's no magic line exactly at $48. There's a zone, a box that goes in between all the supports just to make sure we have the right general area before we start seeing price go in the upwards direction. Easy. So what is a trap? Traps are not random accidents. They're predictable byproducts of crowd behavior. Every retail trader is looking at the exact same textbook support levels and using the exact same popular indicators, drawn from the exact same swing lows. When thousands of traders place buy orders and stop loss orders in the same narrow price band, that band becomes a magnet for exactly the kind of move that hurts the most people. So market makers and algorithmic liquidity providers know where the crowd is positioned because it is visible in the order book. A brief push below an obvious level can trigger a wave of stop loss selling. So like this. Okay, let's say someone had the stop loss below this black line. Once you see it go down, boom, it's going to go ahead and give a lot of volume and pressure for sellers to then step in at. Okay, this would be a trapped level once the support decides to get broken. So anyone who bought there just turned into liquidity for sellers. Okay. So a brief push below an obvious level can trigger a wave of stop loss selling and liquidate over leveraged longs, providing cheap liquidity for larger players to buy from. Right before price reverses and leaves late buyers even further underwater than the traders who got stopped out. So herd behavior. Everyone sees the same textbook level, turning into a predictable magnet. Let's talk about liquidity grabs. Liquidity grabs happen when price is often pushed just below support, just to trigger stop losses below reversing. So you guys might have seen, maybe an instance like this. Buyers still stepping in the same area of support, here and here. It might not be down to the exact tick, but anyone who sold a stop loss below here, and if price still bounced, they would have been taken out, uses liquidity. So make sure you guys set your decent stop loss. Try to have your stop loss right underneath support, super duper tight. That can hurt you a lot. And FOMO entries, watch out for that. Buying the very first touch before any proof out of fear of missing the bounce can really, really hurt you. And confirmation bias. Seeing a bounce because you want one, not because price actually showed one, really, really matters. So, have you guys ever bought at a level, watched it wick below your stop loss by pennies, and then rip? That's not bad luck. That's a mechanism we just described playing out in real time. So set your stop loss to another support below where you're trying to get in at. Don't just put it right below the area of support where you're trying to enter. Find another support below that. Make that your stop loss. And let's talk about the anatomy of a bull trap here. So a bull trap is any pattern that convinces buyers that a low is in, right before price proves them wrong. They can come in a few recognizable shapes, and once you can name the shape while it's forming, you stop reacting emotionally and start reacting mechanically. And the goal of this lesson is pattern recognition. You don't need to predict which type of trap is coming. You need to recognize the type of trap that is happening in real time and refuse to act until the pattern resolves in your favor. So type number one, okay, the first touch trap. So a lot of you guys might see price tapping like this. Boom, okay. Make sure you guys have a good price close. I like to wait for like a 15-minute close, for example. Make sure that the area of support is real. Two, the failed reclaim. Okay, let's say price falls below an area of support, snaps above it, and then decides to go ahead and bounce above it again. Okay, easy. And then you're going to have the slow bleed. Okay, support holds on light volume and then quietly grinds through it over several sessions. So you guys might see this. You might see it holding, and then over time, you might see price slightly fall below. Okay. And confirm the reaction before you act. This is going to be rule number one. Confirm the reaction before you act. The single highest leverage habit you can build is this. Wait for price to move to the level before you commit capital to it. Proof comes from the candlestick behavior at the zone. A long lower wick shows sellers pushed price down and buyers forcibly rejected it within the same candle. A bullish engulfing candle shows buyers overwhelming an entire prior red candle in one move. And this is not about being clever. It's about shifting from prediction to reaction. You are no longer guessing where price will bounce. You are watching for evidence that it already did, then acting on that evidence with a plan that's already prepared. So the long lower wick, okay, let's say price tested the lower entry bar and buyers forcibly rejected it before the close. And bullish engulfing candle. A strong green candle fully swallows the prior red candle's range, okay? And let's say higher lows. Higher lows are going to be like this. A lot of your entries are going to be like this. You're just getting in the next staircase. The new pullback lows that sit above the previous low is going to signal that price is going within an upwards direction. And understand that patience beats speed. The candle must close with confirmation. A touch mid candle proves nothing yet. Okay, price can easily wick at a support zone and then burst through it. So make sure you guys have a good candle close that you look at. I like to wait for a 15-minute candle close, a 5-minute candle close, or a 30-minute candle close would even work too. Okay, so just make it simple. Don't make it hard. Don't make it difficult. And I just want you guys to be able to succeed. Okay, and it's going to be really easy to succeed on these charts the more patient you are. You have to learn how to wait. I even have patience tattooed on me here. Sometimes we got to wait. You know what I'm saying? We got to wait. Wait for price to get to where you want it to be at, and then you're going to be able to dominate. I promise. Okay, I promise. Okay, just give it time, guys. Give it time. Give it time. You guys are going to be profitable. I promise. So multiple time frame alignments. Okay, I like to go from my monthly down to my weekly, to my daily, to my 4-hour, and then the 1-hour, 30-minute. So a support level that only appears on the 5-minute chart is really noise. A support level that appears on the daily, the 4-hour, and the 1-hour is real structure. That's how you avoid fake outs. A lot of you guys just stay on the 1 minute and expect to catch a trade there. You got to use your higher time frames. See it on every time frame, scale down, make sure it's real. Alerts, give it a chance. Too easy. So the more independent time frames that are agreeing on the same zone, the more real capital is likely resting there, and the more reliable the reaction signal becomes. The correct process is to zoom out first, identify the meaningful zone on the higher time frame, and then drop down to a lower time frame, only to time your entry with more precision once price actually arrives at that zone. So you have to zoom out on your higher time frames first. Okay, make sure you guys, once again, zoom out on your higher time frames. Please. Okay, please. So identify the real support zones on the daily, the weekly, and your 4 hour before anything else. Then you can scale down to your 30 and see if it's real there too. Stack the time frames. Use your confluence, monthly, weekly, daily, 4 hour. We're going to be going over some chart stuff, how to find support right after this, okay? But don't make it hard. And the weight of the evidence. More time frames agreeing on a zone means a statistically stronger level. And lower time frame zones aren't always going to be reliable. Make sure that you see the zone on your high time frame and your lower time frame. Get the whole view of everything. Take that trade. So pull up any chart, and I want you guys to try and find a zone that reacts on the daily and the 1 hour. Now compare that level to a random level that only shows up on the 5 minute. Which one would you trust with real money? So volume speaks louder than price. Price tells you what happened, and volume tells you how much conviction was behind it. A genuine bounce off support is usually accompanied by rising volume on the reversal candle. Real buyers stepping in with size, and a fake bounce often happens on thin, unconvincing volume, which means very little real capital agrees with the move, and it can unwind just as easily as it's formed. And the volume climaxes matter too. A sudden oversized volume spike at support can mark capitulation. The last panic sellers finally throwing in the towel, clearing the way for a genuine reversal. Okay, so volume speaks a lot louder than price, guys. On the other hand, if support breaks on usually heavy volume, treat that as a real structural shift, not a blind level to buy. Okay, so price might just be coming to another level of support and wanting to bounce down here. So understand that low volume bounces are suspicious. Okay, that's a lot of the times price is hunting down at these levels because there's buyers sitting there, which means price will be sent up high a lot of the times after it comes in these contacts areas of supports. And high volume breakdown equals danger. So if support breaks on heavy volume, do not try and catch the falling knife. Okay, you can lose a lot of money like that, and I don't want you guys to go through that at all. So wait for the retest. After price shows an initial reaction off support, the highest quality entry is often not the first bounce, it's the retest. So say here, and this can be relative depending on what time frame you're looking at. Okay. So let's say price decided to bounce over here to the left on the daily. Let's say price came down, price decided to come back into the zone here and give us a wick up, right? This would go ahead and be the first one here. So this would prevent you from getting burned here. And when you guys just see the reaction come at a later time again, it's going to really, really confirm that and give you a lot of data. So the trade-off is real. Waiting for a retest usually means buying at a slightly higher price than the absolute bottom. In exchange, you get a much clearer invalidation point than the evidence that sellers want to stay there. Okay, so when you guys see price, say price is doing this, right? Price is going up from the bottom here. I'm cool with catching the stare. You know, if I miss the absolute bottom, that's fine. Okay, I don't know if price might want to even do it from here. But say price had a support over here. You know, I'd rather take this. This is now showing me that the trend is confirmed. I could easily go ahead and close at resistance, and that'll go ahead and be my setup. And then I could do stop loss at the previous area of support. Too easy. Give yourself room for your support. And a lot of times that your support that's below your entry support is going to be your stop loss. Because if price breaks below where buyers were at before, then that's really GG's. So where to place your stop? Once again, put your stop below the zone. Okay, I like to put the stop below the stop loss that's below where I'm currently at. Okay, and that makes it real simple and easy. Got a call there, that's my bad. But anyways, here, when it comes to putting your stops, okay, don't be too strict on yourself with your stop loss. Okay, a lot of people like to put their stop loss right below the area of support that they're trying to get in at. Don't do that. Okay, find an area of support below that and then put your stop loss down there. Say if price bounce down here too, then my stop loss would be at the area of support below down here, not at right below my entry. That's not enough room and you're going to lose a lot of money on that, doing that on accident. So pick your trigger so you guys can have a confirmation entry. Wait for the candle to close bullish, then buy the open of the next candle and limit in zone entries. Okay. I want you guys to try and get as lowest to the next staircase as possible. Okay. But if you have to buy a little above it, it just is what it is. Okay. And breakout retest entries. Enter on the next retest of the zone after the initial reaction is already confirmed. Okay. So say price, once again, bounce here to the left. Say price decides to invalidate, run through it, come back up and bounce here again. This is going to be a retest. Never buy a falling knife. Okay, if you guys see an area of support just not bouncing, don't try and buy there. Okay, don't try and buy while price is falling. Wait for price to stop, pause, then you buy. So we're going to go ahead and go through some examples here. So I'm going to go ahead and show you guys something here. Okay, this is something I gave out to my group, and we've been making some good money on this stock here. So this stock is going to be Figma. So as you guys can see, I have everything marked out here. I'm going to have these two areas of support, which are marked out here, signaling that price wanted to buy in an upwards direction here. Cool. I didn't get in at the absolute bottom, so I went ahead and noticed price again on my daily, creating support here, here, and here. I then saw price go in an upwards direction again. Then I see an area of resistance being created here. We smashed through that. I then could have saw on this red line where we entered at an area of support right here. Okay. Waited for price to come down to the red line. Boom, bought up right off of that. And then as you can see, price has just been going in an upwards direction for days. So it's extremely easy. I know we're going to head straight up here to this 30s area. And it's just really, really fun. Okay, I just want you guys to get wealthy. I want you guys to get rich. I don't want you guys to be behind. I want you guys to just stack up this paper and to just keep going hard. Okay, don't make trading difficult. Just buy low, sell high, read the staircase. If you're still struggling, if it's too hard for you, head over to StackMODE.net and let me get you guys a lot of help. Peace.